Hi folks, welcome to the Financial Argument. Not just regionally, but the entire U.S. banking system is sounding red alarms. Even major banks are caught up in this major problem. And this points to one thing: the entire banking sector is collapsing before our very eyes. Today, I will share with you 14 significant signs that indicate the impending collapse of banks. Since March, the deposit amount in American banks has decreased by $400 billion, and just last week, it further decreased by a staggering $70 billion. Despite the Federal Reserve's incredible interest rate hikes, banks are not offering similar interest rates to their customers. Fleeing from banks quickly, they are shifting to other investment instruments, particularly money market funds, where they can earn higher interest rates. As I mentioned earlier, after the banking crisis in March, which only revealed the tip of the iceberg, a significant amount of capital had already fled, and as you can see now, it has never returned to its previous levels. If you take a historical look at the deposit outflows I mentioned earlier, the graph you are currently witnessing shows something even more terrifying. This graph depicts the amount of money withdrawn from American banks when significant events have occurred since 1973. Take a look at the withdrawals during the 2008 financial crisis and the 2000 economic crisis. During those periods, the withdrawals didn't even surpass $100 billion. However, today we are seeing levels close to $1 trillion. We are talking about an unprecedented outflow in history. This is a profoundly unsettling historical record for American banks. So the question arises, what is the significance of this? The answer is quite simple. In any banking system, if banks are losing their deposits, it becomes exceedingly difficult for them to extend credit. They become incapable of granting loans. In today's economic framework, this means the primary source of income for a bank vanishes. Have you also noticed the significant drop in the bank credit graph? In just the past week, we've witnessed a decrease of $16 billion in loans. Since the banking crisis in March, there has been a continued downward trend, and American banks are experiencing a substantial contraction in loans. This is a deeply troubling development for any economy. Even when bank credit was at previous levels, it was worrisome. The system relies on free money printing and massive debt, yet to sustain economic growth, loans should continually increase. Even in a system of unlimited money printing, we're seeing a decline in loans in the United States. Even if these credit levels remained at their pre-March levels, it would still signify a disaster. So why are all these disasters happening? The Fed implemented a rapid interest rate hike to curb inflation. However, as I mentioned at the beginning of the video, banks are not passing on these interest rates to depositors, causing depositors to panic and make an incredible rush to withdraw their funds from these banks. Furthermore, there's another issue caused by the interest rate hikes. Banks are legally required to hold bonds. Large institutions often hold bonds, treasury securities, and even corporate bonds instead of keeping cash. When interest rates rise, the secondary market value of previously issued bonds with lower interest rates falls. For example, if a bank purchased 30-year treasuries in August 2020, their value has now dropped by 47% in the secondary market. This represents a tremendous loss for the bank. If the bank holds these bonds until maturity, the loss won't materialize, and they will receive the promised amount at the end of the term. However, as seen in the graph earlier, with the record-breaking outflow of deposits, when someone comes to the bank to withdraw their cash before the maturity of these 30-year treasuries, the bank is forced to sell them in the secondary market at a loss. Consequently, the bank has to bear this 47% loss. This was fundamentally one of the reasons why some banks went under in March 2023. When banks can't find cash during cash shortages, especially when deposit outflows reach record levels, these losses contribute to their downfall. Of course, when banks are in a bad state, it reflects on the economy and credit growth. The blue line marked on the graph represents leading economic indicators. As you can see here, the growth rate is declining. The gray line represents the real economic growth, after deducting inflation. However, there's a significant anomaly here as well. While leading economic indicators have dropped, a period when economic growth remains this high is reminiscent of the 2008 financial crisis. Similar situations occurred during the 2000 economic crisis, but the most obvious example is indeed the 2008 financial crisis. Currently, experiencing something similar is a significant sign, particularly for the banks, that we're entering a highly troubled period. It's quite clear that American banks are grappling with unstoppable problems. Another factor exacerbating this situation is that these problems, the same interest rate hikes, and the same bond mechanisms are also present in other major economies. For example, as you can see in the graph, European banks lending to households has reached the worst levels in history. Even in 2008, household loans in Europe didn't face such difficulties. A similar situation occurred during the 2020 crisis and the 2013 European banking crisis, but it wasn't this dire. It's worth reminding that during the 2013 banking crisis, Greece had completely collapsed economically, and even after a decade, they are still struggling to recover. Even back then, the situation wasn't as dire for Europe as it is now. Similar to the United States, the situation in the United Kingdom is also putting pressure on banks. On the one hand, banks are struggling, but on the other hand, they are pressuring zombie companies that can't obtain low-interest loans due to their inability to secure credit. The term zombie companies refers to firms that can barely cover their interest payments, let alone pay off their principal debt in normal times. There are dozens of them in the U.S. stock market. The chart you see here represents the bankruptcy numbers in the UK. You can witness an incredible surge in the second quarter of 2023. Even during the 2020 crisis, the numbers were almost a quarter of what they are today. In fact, there was even a decrease in bankruptcy numbers during that period due to government support. What's even worse is that today's figures are creeping dangerously close to the situation during the 2008 financial crisis. It's become evident that the unlimited money system is no longer functioning, and the problems in banks are deepening, heading towards an irreversible collapse. Recognizing this, the Fed announced a program for banks in March. This program essentially states the following. For instance, if a bank holds a 30-year bond and would incur a 47% loss upon selling it, the Fed says, don't incur a loss. Instead, we can evaluate that bond at the price you acquired it in August 2020, and you can use it as collateral for loans. However, the odd part is that these loans come at relatively high interest rates, despite the fact that banks can obtain funding through deposits at very low rates, around 0.1% to 0.2%. But the interest rates on the funds obtained from the Fed are significantly higher. Nevertheless, banks facing insolvency are compelled to participate in this program. As you can see in the graph, desperate banks have taken out over $100 billion in loans. What's worse is that there has been no decrease in these loans. They continue to rise, staying at their highest levels. This indicates that there are troubles in the banking systems, primarily in the United States. Even if it's not widely discussed in the media, and central bank officials don't publicly acknowledge it, the problems persist. The problems in the banking sector are particularly threatening for regional banks. As long as all the issues I've mentioned persist, there will continue to be difficulties in the banking index. Last week, the KBW Regional Banking Index dropped from the 94 level to the 90 level for regional banks. Brent crude oil prices continue to rise, with Russia and Saudi Arabia announcing their agreement to extend production cuts until the end of the year. However, it's highly likely that the recent surge in Brent crude oil prices is not solely due to production cuts. For those who may recall, production cuts have been announced before, but Brent crude oil prices did not rise to this extent. This points to a more concerning issue related to the interconnected nature of global markets. In other words, it's linked to the pressure on collateral chains in the world markets. As collateral chains come under strain, there tends to be an increase in the value of significant assets, including energy commodities like Brent crude oil. This isn't solely due to its utility in the energy and transportation sectors, but also because it plays a role as collateral in global markets. Unfortunately, history seems to be repeating itself, as we witnessed a similar surge in Brent crude oil prices just before the 2008 financial crisis. In reality, many banks, especially regional banks, are failing. However, these events are rarely reported or are presented in a different light. For instance, last month, we witnessed the downfall of 2 more banks in America, and I bet most of you weren't aware of it. Unfortunately, these pieces of news are hard to come by, even through a Google search. Let me share 2 examples. The first is the seizure and closure of Kansas Heartland Tri-State Bank by the FDIC. There's an announcement on the FDIC's official website and a single CNN article about it. I conducted a search, and I couldn't find it covered in other major news outlets, at least not yet. But wait, didn't they tell us that the banking crisis was over? That everything was in the past. Of course, this failed bank was relatively small, with assets of $139 million. What's significant here is not the size of the bank, but the fact that bank failures continue to happen despite the claims that the banking system is sound. Another bank that has gone under is PacWest Bank, but it's being portrayed as if nothing happened. According to the news, PacWest Bank, which suffered significant losses due to a deposit crisis, is said to be acquired by Bank of California. The news may say bank being acquired, but in reality, it signifies that the bank has failed. It's changing hands for a price much lower than market values. The story unfolds similarly, just like when the famous Swiss giant bank Credit Suisse went under and its rival bank, UBS, took over. While markets continue to disregard negative news, a recent statement from the FDIC has revealed yet another painful reality. In its announcement, the FDIC had this to say: "We have noticed that some FDIC-insured banks are not reporting estimated uninsured deposits as outlined in the consolidated reports of condition and income. Today, we are emphasizing to banks the critical importance of providing accurate data." This suggests that certain banks are refraining from sharing this data, potentially with the aim of concealing their insolvency and preventing the detection of deposit outflows. Some unnamed sources, claiming to be knowledgeable about the matter, have reportedly provided information to Bloomberg. According to these sources, the Federal Reserve has quietly issued warnings to certain banks. While these banks may be considered regional, the total assets they manage amount to approximately $250 billion. Although they may be regional banks in the context of the United States, when you consider the total assets under their management, these banks are significant players. It appears that the Federal Reserve has sent warnings to these banks, particularly in areas like liquidity planning, and has emphasized the importance of being more cautious, indicating its oversight. Allow me to pose a question. If, as stated by Federal Reserve officials, or potentially concealed beneath the surface, the banking sector's problems have been resolved, why are these controls, warnings, and inspections being conducted discreetly? More importantly, why are they being kept confidential? Another important point is the downsizing of major banks. Just a week ago, as I discussed in detail in my previous video, Charles Schwab, a critically important bank both in the United States and globally, managing a massive fund of $7.4 trillion, announced their plans for layoffs and the closure of certain offices. The exact number of layoffs that Charles Schwab will undertake remains uncertain, as the bank has not yet provided any specific figures. However, we do know that these layoffs are estimated to cost around $500 million. What began in March as the visible tip of the iceberg, the shocking collapses in the global banking sector and in the United States, reminds everyone of the 2008 financial crisis, and as a result, serious erosion of trust can be seen even in giant banks worldwide. The sense of panic is certainly not unfounded, as many banks have gone bankrupt in the United States and Europe. When you look at the big picture, especially when a bank like Credit Suisse, once referred to as the fortress of banking in Switzerland, the star of the industry, goes bankrupt, it goes far beyond mere market fluctuations. It necessitates a fundamental questioning of the global banking system. If you were to conduct this examination, it would reveal that the future is far from bright. What I've discussed today and all the developments that have taken place should not be viewed solely as a banking crisis. It signifies that these markets, which have become sick and corrupted, addicted to free money, and the financial system heavily reliant on debt, can no longer be cured in any way. That's why it's not just the troubled banks. Even worse, it's the most obvious sign that the financial system has ruptured. Who do you think could be next? Let me say, an American banking giant, and you can say many more than that. Please ensure you are prepared for what's approaching. God bless you all.